Hey everyone, and welcome back to The Explainer. Today, we're diving into a company that is quite literally making Wall Street do a massive double take. We're talking about IES Holdings, ticker symbol IESC. Now, if you've been watching the markets at all lately, you know this stock has been absolutely defying gravity. But we aren't just looking at the charts today. Oh no, we are going right under the hood to look at the hard financial data, the profitability metrics, and those underlying valuation multiples that are powering this phenomenal run.
Okay, let's dive into this. 4,943%. Just let that sink in for a second. That is the 10-year total return for IES Holdings. Basically, if you had parked some capital there a decade ago, it would have multiplied almost 50 times over. It's an absolutely staggering figure, right? But as we know, numbers like this don't just happen by accident. They're driven by massive, structural shifts in underlying business performance and, crucially, shifts in what the market is currently willing to pay for that performance. So here's our roadmap for unpacking all of this. First, we'll map out the unbelievable stock run. Second, we'll look at the engine driving that growth. Third, we're going to talk about paying the premium price. And finally, we'll bring it all together with the intrinsic value reality.
All right, starting with part 1, the unbelievable stock run, tracing IESC's meteoric rise. Let's isolate the recent price action just to grasp the sheer momentum we're dealing with here.
Let's move to the yearly breakdown and see how this builds. Now, after taking a pretty rough dip of about 29% back in 2022, this stock essentially strapped itself to a rocket ship. I mean, look at this. In 2023, it posted a 122% return, and then it accelerated in 2024 to over 153%. 2025 gave us another 93%, and year-to-date in 2026, it's already up 68.5%. We're talking about consecutive, compounding, triple-digit momentum here. It's wild.
And when we smooth those returns out into a compound annual growth rate, or CAGR, the acceleration becomes even more obvious. Over the last 5 years, the total return CAGR sits at a highly impressive 66.9%. But watch what happens as we get closer to today. That growth rate just explodes. The 3-year CAGR is nearly 146%, and the trailing 12-month total return, it's compounding at a blistering 222.1%. The momentum is quite literally speeding up right before our eyes.
Okay, so that brings us to part 2, the engine driving the growth, examining the fundamentals, because now we have to ask the most important question, right? Why is the stock up this much? Does the actual underlying business justify these massive share price increases?
To answer that, we've got to look at return on invested capital, or ROIC. Now, as you probably already know, this is the ultimate measure of how efficiently a company uses its debt and equity to generate profitable returns. It's essentially the output they generate for every single dollar of input. And this brilliantly illustrates exactly what's happening inside IES Holdings. Their capital efficiency is consistently and impressively expanding. Look at the 5-year average ROIC. It was a really solid 18.98%. But over the last 3 years, that expanded to 23.39%. And today, it's sitting at a phenomenal 30.88%. They aren't just making more money. They are fundamentally becoming vastly better at making money. You can actually see the sheer force of this efficiency rippling right through their top and bottom line metrics. Trailing 12-month revenue sits at almost $3.5 billion, and net income over that same stretch is over $341 million. But here is the real kicker. The 3-year net income compound annual growth rate is an insane 93.91%. Profits are practically doubling every single year, and the absolute best part? They're pulling this off with a debt-to-equity ratio of exactly 0. No debt. This booming growth is pure organic business strength. So we clearly have an undeniable, booming business on our hands, which brings us to Section 3, paying the premium price, assessing valuation multiples. Because, as we all know, identifying a great company is really only half the battle. The other half, figuring out what the market is actually willing to pay for it today.
And for that, we start with the classic price-to-earnings, or PE ratio. Just as a quick refresher, this evaluates the current share price relative to its per-share earnings, giving us a baseline for how expensive the stock is.
Now, what's really interesting about this slide is the massive divergence between what investors used to pay for IESC and what they're coughing up today. The 3-year average PE ratio is 21.98, but today, it is ballooned up to 38.75. That means investors are paying a massive 76% premium right now compared to the company's own recent historical average. The market has completely and aggressively re-rated this stock. And you know what? The story gets even more dramatic when we look at the price-to-free cash flow ratio. Because, sure, earnings can be subject to all sorts of clever accounting adjustments, but free cash flow, that is hard, cold cash. Historically, the market priced this stock at about 37.5 times free cash flow. Today, it's sitting at an eye-watering 75.20. So it has become significantly more expensive relative to the actual, tangible cash the business generates.
And listen, this isn't just some isolated anomaly. It's true straight across the board. The price-to-sales ratio, up nearly 149% from its 5-year average. Price-to-book is up over 101%. Enterprise value to EBITDA is up almost 94%. By literally every relative measure we look at, the multiples are heavily elevated compared to historical norms.
Which brings us to our final act, Section 4, the intrinsic value reality, discounted cash flow analysis. We've looked at the relative multiples, right? But now, let's get mathematical and estimate the absolute intrinsic value based on projected future cash flows.
When you actually crunch the DCF numbers for IES Holdings based on its free cash flow, you get a pretty stark reality check. The current market price, what you have to pay today to buy a share, is $655.64. But the calculated fair value price, meaning the intrinsic value of the cash it will actually produce down the line, sits all the way down at $247.84.
So the crucial point is this leaves investors with a margin of safety of negative 164.54%. Now, impartially speaking, a negative margin doesn't mean the stock is going to crash tomorrow. Momentum is an incredibly powerful force in the market. But what it does signal loud and clear is that the stock is currently priced for absolute perfection. The current market price is already baked in years and years of flawless hypergrowth execution.
And because of that sky-high price tag, the actual yield you get as an investor is shrinking fast. The free cash flow yield is currently just 1.35%, which, by the way, is down over 68% from its 3-year average. So at these heavily elevated prices, any new capital entering the stock today is simply buying a historically low yield compared to what investors were getting just a couple of years ago.
And that leaves us with the ultimate tension here, performance versus price. IES Holdings is, without a doubt, an objectively incredible business right now. Booming net income, zero debt, rapidly expanding capital efficiency, it's a textbook success story. But the market has pushed valuation multiples to extreme historical highs. So it leaves us with one critical question to ponder. Is incredible compounding growth worth paying for when it comes with a deeply negative margin of safety? I'll leave the data on the table and let you decide. Thanks so much for joining me on this explainer, and I'll catch you next time.